Hello, everyone. So let us now continue with the discussion. That means we have already covered with so many chapters in our revision session. So as we have already discussed the sequence of our revision, we have followed it thoroughly and we have finished the first part of it, which spoke about risk assessment, planning and evidence. Then we took about the topic of internal control, where we spoke about internal audit and systems and control. Then we understood about the procedures, and basically these procedures were substantive audit procedures, wherein we understood how we validate the assertions made by the management and how do we obtain sufficient appropriate audit evidences for the purpose of supporting our audit opinion. Okay. So now let us continue with the next one, which is also a very important discussion, where we talk about the topic of completion and review. So basically now we are going to take two different chapters, and both these chapters are actually going to serve as the last leg for auditing. Okay, that means whenever the auditor starts the audit, so he plans the audit, he decides the audit procedure, he does the risk assessment, does the testing of controls. Based on the result of the test of controls, he then goes on for deciding how much substantive procedures have to be applied. Finally, he'll obtain sufficient appropriate audit evidences, and then even then, after that, we cannot say that the audit is completed and he's in the position to give the audit report, because there are some additional responsibilities imposed on the auditor, which even after performing the substantive procedures, even after obtaining sufficient appropriate evidences with respect to the items on the financial statements, even after that, he is required to do certain more procedures which talk about what is completion requirement, that is what is a review requirement, or once again what he is required to cross-check, or he has to confirm about few more matters. Only then he will be able to give his audit report. So now what we are going to discuss is regarding review and reporting, where after finishing the substantive procedures also, what additional steps the auditor has to perform, or what are the additional responsibilities imposed on the auditor, which he requires to perform. Only then he'll be able to give his audit report. And then we will move on with the understanding of how the audit report is prepared when you give a modified opinion, when you give an unmodified opinion. And if the auditor requires to give some kind of additional communication or additional information through his audit report, can he do that? And if yes, how and in what paragraphs is he going to include those details? So basically the entire discussion that we are going to have in today's session is with respect to first reviewing. That is basically the last leg before the audit report is prepared, and then preparation of the audit report, where we will be able to understand all the paragraphs included in the audit report, every single matter which has to be taken in the audit report, what will happen in the case of a modified opinion, what will happen in the case of unmodified opinion. All of this we are going to have a detailed discussion. Okay, so with this, let us get started with the fourth set of our topics, which is review and reporting, where we take up two topics. One is the completion and review, and second is going to be reporting. All right, so let's get started. Okay, so let us keep the approach same. So I'll be having all the important concepts to be discussed with you from the topic. And then where required, we will also do the reference to the study material and also then pick up the questions from the exam kit, so that you get a confidence that yes, you know the concept very well and you'll be able to attempt in the examination also well. Okay. So this is basically review and reporting, the clubbing which I had done based on different topics. Okay, so this comes under the clubbing of review and reporting, where we have two topics to be discussed. One is completion and review, and second talks about reporting. Okay, so as per the study material, the study text, chapter 11 is completion and review, and chapter 12 is about reporting. So basically, we are now revising chapter 11 and chapter 12 from the study material. Okay, so let us get started. Now, first of all, what do you mean by completion and review? Okay. Now, as we already know how audit procedures happen, so basically how audit is conducted, we know first you sign the engagement letter, then you do planning begins. Okay, then you also have the risk assessment procedures. Based on that, there could be a modification to your planning. Then you do the performance of test of controls. Then you do test of details. Okay, so till here is something that we already know. But then after performing test of details, you do have sufficient appropriate audit evidences with you. Even then, because of this particular topic, you directly cannot jump on and prepare the audit report. That means you cannot come to a conclusion. There are some additional matters which the auditor is required to check. There are some additional considerations for the auditor before he prepares the audit report and signs the audit report. And these basically talks about matters such as subsequent event, going concern. Okay, it talks about overall review. Then it talks about performance of some analytical procedures at the end. So that comes under overall review. Then we also talk about evaluation of misstatements. Correct? And then finally, we are going to talk about, yes, now the auditor is in the position that he will be able to give an opinion. Also, the auditor is required to obtain certain written representations from the management, which he will obtain at this particular stage. And only after all of these are also completed, then we say, yes, we can now draw a conclusion, we can now give opinion, and this opinion we can deliver through an audit report. Okay, so let us understand what are the requirements for the auditor to do at the end of the audit. Okay, now first we check for something called as subsequent events. Okay, so let us understand how subsequent events are. Let us understand what we mean by subsequent events and what is the responsibility of the auditor with respect to subsequent events. So basically you have IAS 10, okay, which talks about event occurring after the balance sheet date. And you have ISA, International Standard on Auditing 560, which is talking about subsequent events. Okay. So now let us understand a timeline. Okay. Here you see that this is the financial statement reporting period. Let us assume it to be 30th of April. This is the date of auditor's report. Maybe you can consider it to be June, okay, or maybe in the mid of July. And then you have the date on which the financial statements are published to the public, or you can talk they are published to the people who are required to have it, that is stakeholders. So there is going to be financial statements prepared. Here the audit will be conducted, where audit report will be issued, and after audit report is issued, the audit report will be handed over to the management, which then will make it public or make it available to their stakeholders. Okay, now the meaning of the subsequent event part is these events, that is the events after the financial statements are prepared, up to the preparation of the audit report, and the facts that become known to the auditor after the date of auditor's report, okay, and the date on which the financial statements are issued. These events, we call them to be subsequent events. Now, this particular ISA 560 talks about the auditor's responsibility with respect to these particular events. Okay, now, when you talk about the international, when you talk about IFRS, we talk about a situation where we talk about events occurring after the balance sheet date, where they discuss about two types of events. One is called as the adjusting event, other is called as the non-adjusting event. Okay, now, what is the meaning of adjusting event? That means there is a condition already existing on the year ending. That is, in my example, on 34th April, the event is already present. But in this particular period, there is something that happens which affects the position which was already existing on the financial statement date. So in this case, when that event is already present, it is already existing. And here there is something that happens, any event that happens, which is going to impact this particular amount in the financial statement, then the management is required to adjust this particular event or adjust this particular matter in the financial statements. So there could be a debtor's balance outstanding and the debtor has now become bankrupt in this particular area. So what in this particular period? So in this case, this particular event will definitely impact one of the item of the financial statement, that is debtor's balance has to be written as bad. So this particular event is called as what? Adjusting events. Similarly, on the other line, we have non-adjusting events where we say the event will not be present on the balance sheet date, but there is something that has become that is an event which occurs here, which will significantly affect the financial statements. So for that, what happens is the management is required to provide only a disclosure. You don't touch the numbers, but you have to give a disclosure of this particular matter. So basically, it is the management's responsibility that if there are any events which have happened between the financial statement to the date of auditor's report, depending upon whether they're adjusting or non-adjusting, they have to either make an adjustment in the financial statement or they have to provide a disclosure in the notes to accounts. What is auditor's responsibility? The auditor's responsibility will be to ensure whether management has done their responsibility correctly or not. So now the auditor, after he's finished all the work of the audit, then he will look into any kind of event or any kind of circumstances which are present, which is going to impact the position of the financial statement. If he finds out any particular matter which will be talking about it to be adjusted or it to be a disclosure requirement, he has to tell the management to do the same. And if the management agrees with the auditor and amends the financial statement, then we have absolutely no problem. We can go in for providing unmodified opinion. But if the auditor tells the management about the modification or the amendment in the financial statement, whether either you have to adjust or you require to disclose, and the management refuses that they are not going to do such kind of adjustment, then depending upon the materiality and the pervasiveness, the auditor will go on giving a modified opinion. Got it? So that is regarding to when we talk about the financial statement to the date of auditor's report. On the similar lines, what will happen if there are some facts known to the auditor after the audit is completed, that is audit report is prepared to the date of the financial statement being issued. Now, there could be a possibility that there are some events which are known to the auditor after the audit is completed. Basically, it is not the responsibility of the auditor, or you cannot say auditor will be responsible primarily for anything that happens after the audit report period or the audit report is prepared. If that is the criteria, no, then audit will never come to an end. So basically, after preparation of the audit report, audit is coming to an end. But suppose there are some events known to the auditor after the audit report is prepared, but he believes that no, if this I would have known earlier, I would have given a modified opinion. Understanding? So in that case, what he will do, he will see whether audit report has already been given to the management or it is with him. If suppose audit report is still with him, then he can go for modification if the management does not agree to modify the financial statements. But if the management agrees to modify the financial statement, amend the financial statements as required for doing all the adjustments or disclosures, then no problem, you can give an unmodified opinion, no problem. But if the management denies, then the report is still with you, so you can go and give a modified opinion. Okay, but suppose if the audit report already the management has issued to the stakeholders. Now in that case, what will happen is, if the auditor comes to know about a matter which he believes is going to impact the opinion on the financial statement, then he will request the management that they are requiring to amend the financial statements and they have to reinstate the financial statement. If the management agrees, then no problem. The management will call for the financial statements. They will do the changing everything and the auditor will issue a new audit report where he can put the EOM paragraph telling that we have just checked the new things that have been amended and what has been added on. But if the management does not listen to the auditor and does not take any action with respect to doing any kind of changes to the financial statement, neither they're ready to disclose, nor they're publishing any information regarding not to rely on them, then in that case, the auditor should take some kind of remedies or some kind of action so that the public will not rely on the audit report given by him. Obviously, here he'll go for legal advice, wherein he can go for public notice to be issued and he can tell the people not to rely on the audit report which has been published by the management. Got it? So this is the basic idea regarding how subsequent events are tested by the auditor. This in the main classes we have done it in detail. Okay, so you will get a very clear understanding. But as of now, for in summarized manner, what you have to take in is there are two types of events: financial statement to the date of auditor's report, and from the date of auditor's report to the financial statement being issued. Here you look into the matter of adjusting and non-adjusting, where it becomes the responsibility of the auditor to look into the matter. Here it is basically not the responsibility, but yes, if the auditor believes if this fact was known to me earlier, I could have changed the report, then in that case, he cannot keep quiet. He'll further investigate the matter and he will inform the management about the further actions to be taken. If management listens, he will issue the new audit report with an EOM paragraph telling it is only with respect to the new matters which have been reinstated. But when I talk about management just not listening to the auditor, then obviously in that case, the auditor will take legal actions where he can also give up the public notice and tell the people not to rely on that audit report which has been issued. Okay, all right. So this is regarding subsequent events. Okay, so we finish with the subsequent event, and as we have discussed, it talks about even IAS 10, which talks about event occurring after the balance sheet date, where we first have to understand what is adjusting event and what is non-adjusting event. Okay, then after we check about subsequent event, there is one more responsibility, very, very important on the auditor regarding the going concern part. Okay, now this also is very important. Let us have a detailed understanding about it. Now, first of all, very important, you need to understand what is going concern. And as you all must be studying in the part of financial reporting, you know what a going concern is. Going concern is an understanding or an assumption made by the management that their entity is going to continue for a foreseeable future. That means they do not have any intention, neither a need for them to liquidate in the coming foreseeable period, which is considered to be 12 months. 12 months obviously from the financial statement, but obviously some countries do not take financial statement as a 12 months period to be calculated. They take it from the date of approval by the management, 12-month period. Like when you talk about UK takes this particular aspect from the date the financial statements are approved, from that period 12 months. But in country like India and all, we take it from the date of the financial reporting statement. That is in India 31st March, from there 12 months. Okay. So we say that management can prepare the financial statement on the going concern assumption when they believe or when they have an understanding that there is neither a need nor an intention by them to liquidate or wind up in the coming 12 months period, which is considered to be a foreseeable future. Okay, now, in this case, understand how will it impact the reporting. If financial statements are prepared on the going concern basis, then obviously prepare in the usual manner where books of accounts are recorded in the book value and all of those things. There will not be much changes. It will be regularly the way you are going to prepare the financial statements. But suppose if financial statements, okay, if the management says going concern is inappropriate, that means we are not following the going concern, then in that case, the management is required to give the financial statement in breakup values. Breakup value as in it is going to be, assets will be at the realizable value and liability is going to be at the payment value. Okay, so basic accounting only will change. The preparation of the financial statement will change when you prepare the financial statement as per going concern and when you prepare the financial statement not as per going concern. Okay, now, as I already told you, it is the directors or the management's responsibility to determine whether their entity is a going concern or not. So basically, the auditor has to ensure, has the management taken into account if there is any kind of material uncertainty which is present, okay, which can impact the entity's ability to continue as a going concern. So if suppose the management has understood that there is some kind of negative cash flow or their business is failing or they're unable to repay their loans on time, there's a continuous outflow more than inflow. So there are a lot of indicators which are telling that there could be a possibility that the business cannot continue. So there could be a material uncertainty present. However, the management sometimes will have a very good backup plan. They'll have a mitigation plan. So when the management is having a material uncertainty present, but they have a backup plan also, then in that case, obviously they'll prepare the financial statement as per going concern. But in the notes to accounts, they're required to give a disclosure regarding this kind of uncertainty present and also the impact of this kind of uncertainty. If suppose the management has given an adequate disclosure about the material uncertainty and they have prepared the financial statement as per going concern, then obviously the auditor will go on giving an unmodified opinion. Okay, but suppose if the going concern assumption is not appropriate and the management is not preparing, is preparing the financial statement as per the going concern assumption, that means going concern is inappropriate, but the management is preparing as per going concern, then in that case, obviously the auditor will end up giving what opinion? Adverse opinion. Okay, so it is the duty of the auditor that he also should check into any kind of indicators present, which is going to cast a doubt on the entity's ability to continue as a going concern. So during the course of his audit, if he comes across any assessment where he sees that there is a negative cash flow, they are unable to repay the debts, there is a major catastrophe which has affected the business, there is a continuing liability which is arising, major supplier is gone, okay, only one customer they had and that customer has stopped taking from you, so you have lost a market or something like that. So there are indicators. So it is the duty of the auditor to communicate with the management, ask them for the mitigation plans. If management has a proper mitigation plan, then fine, you can end up giving an unmodified opinion. But even if you give unmodified opinion, the auditor is required to report as per SA 570. That means what? In the audit report, you will have a paragraph called as material uncertainty relating to going concern. There you have to give about this material uncertainty what is present. Though you are giving unmodified opinion, true and fair view, even then you are required to inform the people about this kind of uncertainty. So you bring that in which paragraph? In a separate section in the audit report called as material uncertainty pertaining to going concern. But suppose if going concern assumption is inappropriate and the management is preparing as per going concern, then in that case you are going to give an adverse opinion. And when you give adverse opinion, then you have a paragraph called as basis for adverse opinion, where you are going to write about why you're calling it to be an adverse opinion. Got it? You'll give a reason here. So understand, it is very important for the auditor to first ensure that the management has done the assessment of the going concern properly. Also see that minimum 12 months period has been taken into account for doing the assessment. Then look into the matter. Have they taken into account every possible indicators to assess whether going concern is appropriate or not? Do not trust only the management. You as an auditor should also perform some procedures to see whether there are any indicators of going concern to be inappropriate. Taking into account all of this, then finally the auditor is required to decide about the opinion, that is reporting that he has to do. If suppose management knows about a material uncertainty, but the management has a mitigation plan and the management is ready to disclose this kind of uncertainty in the financial statement, then the auditor will be okay with everything. Then the auditor will give an unmodified opinion, but obviously he will talk to the users about this uncertainty present through a separate section in the auditor's report called as material uncertainty relating to going concern. However, if suppose going concern is inappropriate and the management still prepares as per the going concern assumption, then in that case the auditor is going to give an adverse opinion, and in the basis for adverse opinion he will give the reason for this kind of thing done by the management. Okay, then very importantly understand ISA, International Standard on Auditing 570, will talk about the reporting also. So you have to be very careful when you have to give adverse opinion and when you have to include the matter in material uncertainty pertaining to going concern. Okay, if suppose going concern assumption is not appropriate and the management has prepared on breakup value, even then auditor will give a true and fair view. Okay, so only because going concern is inappropriate does not mean you will give a modified opinion. If suppose going concern is inappropriate and the management has prepared the financial statement on breakup values, even then the auditor will give what? True and fair view. Why? Because they have prepared the financial statements as per the applicable financial reporting framework. And when they prepare as per the applicable financial reporting framework, that means we are giving a true and fair view. Okay, so these are all the permutations and combinations that we have with respect to ISA 570, where the auditor will talk about going concern assumption or his responsibility towards the going concern assumption. Okay, so first of all, what is going concern we need to understand. We understood that the entity should continue to be going through a foreseeable future, that is 12 months. If the material uncertainty existing, management shall disclose in the financial statement. Auditor's responsibility is to ensure disclosure is made. If not, he will give an adverse opinion. If the management has made appropriate disclosure, obviously he'll give an unmodified opinion. Okay, so that is with regard to auditor's responsibility. Also understand the types of indicators available to about going concern would be financial indicators, operating indicators, other indicators. Financial indicators could be, if suppose while doing the audit you come across a situation of the cash flow where there is negative cash flow, or when you're looking into the bank transaction and you see that you're unable to make the payment to the bankers. So you have not seen that there's a regularity in the payment to the bank for their loans that you have taken. Okay, then operating could be that your major customer is gone, the major supplier is gone, or maybe now there is a lot of demand, the demand for the market in the market has come down. Okay, raw material from where you are taking, the particular supplier has stopped business. So a lot of things which will talk about operational indicators. Others could be where there is a change in the government policy. Maybe your product is now banned by the government, or maybe major catastrophe has happened, natural calamity, which has impacted on your business. Okay, but all of these are only indicators, they're only risks. So the auditor will first communicate with the management and understand if they have a mitigation plan, if backup plans and all are there, and if the auditor is satisfied with the answers given by the management. Obviously for that he'll look into the board meeting, board minutes book. He will look into the discussion with the management, check whether really it is reasonable enough. Are they making really arrangements for getting the fund in the future and all that? So basically auditor will do proper investigation, proper inquiry with regard to the mitigation plans. Only don't trust the management. You need to just check, double sure you have to be, alternate procedures you perform, and ensure whether really their backup plans will work or not. Compulsory obtain written representation. Okay, with respect to this matter. Okay, whenever it is the responsibility of the management, do not fail to obtain written representation. Okay, then the next step that is there after you check for subsequent events and the going concern, you talk about overall review of the financial statement. That means even after we finish all of this, that means even after test of control, test of detail, subsequent events we have analyzed, going concern assumption we have checked, even then there are some more things that we have to review. Only then we can say, yeah, we can go to the opinion. Your review would mean that you will again ensure whether financial statements are prepared as per the applicable accounting standards or not. Then whether accounting policies are appropriate and consistently applied or not. Okay, all the misstatements identified have been properly corrected or not. Evaluation has been done correctly or not. Whatever information is there, whatever explanation is there in the financial statement, are the supporting documentations available for that or not? So basically all of these things also you have to review again. You also perform analytical procedures at the end of the year, at the end of the audit, and see whether whatever conclusion you are drawing and what is actually there in the financial statement, whether they're really matching or not. So after doing everything, also we again check for the accounting standards compilation. Whether it is really complied with the accounting standards or not, disclosures are as per applicable standards or not, whether all the laws and regulations have been followed by them or not, accounting policies are appropriate or not, consistently followed or not, all the misstatements have been really evaluated by them or not. Correct? Then also perform analytical procedures to double sure yourself whether what we actually performed, whatever evidences we have obtained, and what really is there in the financial statement is matching or not. So all of this thing you are going to check. Okay, so you will do overall review. Overall review is a double check. okay, on everything that you have obtained evidences on. Okay, then after that you do evaluation of misstatement. Okay, now during the course of audit, obviously the auditor will come across many misstatements. Okay, so whenever misstatements are identified, it is the duty of the auditor that about these misstatements he has to inform the management and ask the management to do the rectification of the same. Okay, management, if they rectify, fair enough. If they do not, then you're going to inform the TCWG. Okay, now very important part is you have ISA 450, which talks about evaluation of the misstatements identified during the audit. Now they talk about evaluation of misstatements. So basically, whatever misstatement you come across during the course of audit, you will communicate all the misstatements to the management, unless and until they're really very small. Unless they're completely negligible, okay, don't communicate them. Otherwise, all the misstatements we communicate to the management and require them to rectify. But sometimes what happens, the management will be reluctant to rectify all of them. They will say only material will rectify, remaining they are not concerned. So in that case, it is very important for the auditor to obtain a written representation from the management that those uncorrected misstatements, okay, even if you take as an aggregate, they will not cross the material level. So management should take the responsibility about the uncorrected misstatements that overall also or in aggregate also, they will not be material to the financial statements. Okay, obviously don't trust only the written representation. You also as an auditor should check whether all the uncorrected misstatements, okay, are in aggregate material or not. Do they have a material impact on the financial statements? All of that you have to take we should be very careful. So all you give it to the management, then management, if they rectify all, we have no problem. But if the management does some kind of optional selection and rectifies few and not the others, then the others which have not been rectified, you see whether in aggregate, will they cross the material level? Talk to management about it, escalate it to the TCWG and understand what is the uncorrected part, is it material or not? If the management says, no, it is immaterial, then obtain from them in writing. Let them take the responsibility, obtain written representation from the management that the uncorrected misstatements, okay, together or individually will not cross the materiality level. That means they will not have a material impact on the financial statement. So all this is given by ISA 450. Okay, so that is regarding evaluation of misstatement. Then comes to a very important discussion again, which we have written representation, ISA 580. Now written representation, first of all, a very important criteria. Written representation is always going to be one of the most common and the most supporting audit evidence that the auditor will try to obtain or auditor is required to obtain in certain situations. Just now we looked into going concern. Okay, then when you talk about preparation of financial statement, designing of the internal controls, complying with accounting standards, preparation of the financial statement as per applicable FRF, all these are the requirements or compliance with laws and regulations. All these are the responsibility of whom? Management. So obviously, it is the duty of the auditor to obtain a written representation from the management that they have complied with all their responsibilities. Okay, so written representation by itself will never be a sufficient appropriate audit evidence. So you cannot say that it is a sufficient appropriate audit evidence based on which we will be forming conclusion and based on which we will give an opinion. Wrong. Always understand written representation are only supporting audit evidences. So you will have to obtain evidences through other means, inspection, observation, recalculation, reperformance, analytical procedures. You have so many procedures available with you. You have to obtain one of the audit evidences, but to just be double sure or to reconfirm, you can also take written representation with that particular matter. This is only a supporting audit evidence. There cannot be a possibility that you have said that we have done the audit by obtaining written representation from the management. Understand, it is management. They have prepared the financial statement. So obviously, whatever written representation they are going to give, how much are you going to rely on it? It is going to be supporting evidence only. You cannot call it to be a complete audit evidence. Okay. So written representation by itself will never be a sufficient appropriate audit evidence. Okay. Then there are some important aspects which will be also questioned in the examination sometimes. So because of which we'll go through the study material and we'll have a little more detailed discussion about ISA 580 written representation, because there are some things like reliability of written representation. Should you trust the written representation or not? Okay, when is it required to trust it? When do you doubt on the written representations? Okay, then steps if the written representations are inconsistent with the other audit evidence. So when you did, inspection of the documents, you got some other information, and when the management provided information, it was different. So if it's inconsistent, then there will be a problem. Then steps if the management refused to provide written representation. You are asking the management to provide written representation regarding some matter. Management says will not provide. So in that case also you start having a doubt in your mind. So this will give you a kind of a understanding something is wrong. So you'll become more professionally skeptic, you'll become more alert. And this will be an indicator something could be wrong in the financial statement. So your overall assessment of the audit, overall planning, everything could undergo a change. Correct? So let us take some part of it again from the study material because it becomes a very important point of discussion. So let's do it again. All right. So we have written representation, and as I discussed already with you, written representations are provided by whom? Management to auditor to confirm on certain matters or to support other audit evidences. They are supporting audit evidences. Okay, then ISA 580 written representation requires the auditor to obtain written representation from the management. So on these matters, as I told you, you have to obtain written representation. Which are these matters? If you understand, they are all the responsibility of the management. They fulfill the responsibility of preparation of the financial statement to support other audit evidences relevant to the financial statement. So you have to validate an assertion. So maybe you're looking in for valuation. So you have done the recalculation, agreed. But even then, just to be double sure, you will also obtain what? Written representation to support the other audit evidences. That the auditor has provided with all the relevant information. So management will give you in writing that whatever the auditor asked for us, from us, we have provided. And that all the transactions have been recorded and reflected in the financial statement. So basically it talks about completeness. So management is going to give a written representation about these 4 matters mandatorily. Preparation of financial statement as a supporting to the other audit evidences. Then they have provided all the information to the auditor as and what he asked for, and everything that has been recorded and reflected in the financial statement. That means nothing they have left out. Okay. A representation to support other audit evidences may be appropriate where more reliable forms of evidence are not available, particularly in relation to matters requiring management judgment or knowing restricted to the management. That means examples like estimates, provisions, contingent assets, contingent liabilities. Now, all of these, you will definitely not get a supporting evidence. So much supporting evidences will not be available, which can prove some matter. So in these cases where it is the management judgment only involved, management understanding only is involved, these are the areas where we more go in for written representation. So if you look at this, okay, they say, where other forms of evidences are not available, particularly in relation to management requiring management judgment, then we restrict ourselves to what? That is, or we ask for ourselves for what? Okay, we go for supporting evidence that is going to be representation. Okay, then, like for example, selection of the accounting policies, whether everything is measured, presented and disclosed as per FRF. Okay, so you can look at all of these. So these are basically like laws and regulation, contractual agreements and all. So for this, we can obviously obtain management representation. Okay. Then the directors have communicated deficiencies to the auditor, specific assertions about class of transactions and all that require management judgment. So all of these are basically what? That responsibility of the management, or where management's involvement is more, his judgment is more. So there, instead of going for other evidences, usually you don't find them reliable. So you definitely obtain written representation in those particular matters. Okay, and here they're very clearly told, written representations are basically not a substitute for more reliable evidences, and they could not constitute sufficient appropriate evidence on their own. So they are only what? They should be sought to support other evidences. They should never become what? Individually sufficient appropriate evidences. Now, how to obtain written representation? Very simple. Basically, you know what happens is, written representation is prepared by the auditor only. The content will be written by the auditor, but it will be written on the letterhead of the client. So on the client's heading, the auditor will frame it, but sign will be given of whom? The client. So it is as good as the client has given the agreement to it. Preparation content will be written by the auditor, because obviously client sometimes will not be aware of how the content to be written. So drafting will be done by the auditor, and on the letterhead of the client, because it is management representation, and the client has to sign. Client means the appropriate personnel like CEOs, CFOs, senior level people who are in charge with that work, they will be signing on it. Then reliability of the evidences, here you have to check important. Written representation are client generated and may be subject to bias. It is therefore potentially an unreliable form of audit evidence. This you can understand very easily. Who is generating? Client. So obviously, is there a possibility of manipulation? Yes. So before accepting any representation or anything coming from the management, you have to take into account their competence, integrity, ethical values, diligence of the management, everything. And also check whether other evidences that we formed by other procedures, did that answer and this really matching or not. If you feel there is some kind of dubiousness, there is inconsistency, that means there is a possibility management could be unreliable. Okay, so that is the way you check the reliability. Steps if the written representation are inconsistent with other audit evidence. Inconsistent means suppose you have obtained external confirmation regarding a particular matter. and management is also providing you something with regard to that particular matter. And these both things don't match. That means here they're telling there is some kind of inconsistency into evidences. So obviously this again will bring up doubt in the mind of the auditor. Written representation could be unreliable. Consider the reliability of the representations in general. Reconsider initial risk assessment. Why? Because if management or information they're providing is wrong, that means more information could be wrong. That means full assessment of the risk will do again. Consider the need to perform further audit procedures. That is obviously when plan will change, further audit also will change. If there are concerns about competence, integrity, ethical value or diligence of the management, the auditor must consider whether engagement can be conducted effectively or not. If not, he will look in for withdrawal. And if suppose laws and regulation do not permit him for withdrawal, then it will lead for what? Disclaimer of opinion. Why disclaimer? Because now you are not in the position to give audit opinion. Because you don't trust the management, whatever information is available inside, they're not reliable because they're all prepared by the management. And we have a doubt regarding their competence, integrity, everything. So I'm not in a position to obtain any kind of sufficient appropriate audit evidence. So in that case, I can end up giving a disclaimer of opinion. Okay. But always we look into the first option, whether we are allowed to withdraw. But sometimes laws and regulations don't allow you to withdraw. So in that particular case, you end up giving a disclaimer of opinion. Okay. Then. Steps if the management refuse to provide written representation, very important for examination. If suppose management is not providing necessary information through the written representation, then discuss the matter with the management to understand why they are refusing. Reevaluate the integrity of the management and also consider the reliability of other representation and audit evidences in general, and also consider the implication on the auditor's report. Understand if the management is refusing and if the management does not have a reasonable understanding to give it to you. Then in that case, what you will believe? No, there is something wrong. There is something which is not acceptable. Something is wrong. That means management is not a people. They're not people of integrity. That means if one particular representation they're not providing, that means they are not giving an authentication to the work which they have done. So because of which there could be a possibility, many other things also in the financial statement could go wrong. So basically the entire audit will come to a change. Your initial risk assessment also will change. Your doubt on the other evidences also will start bringing up. Because see, when you inspect documents, when you do oral inquiries, all these are you're doing from management only. And if one particular idea gives you an understanding that there is an integrity failure, so in that case, every audit evidence will come to a question mark. So in that case, there could be a possibility that you could also end up giving a modified audit report. Okay. And modified could obviously be disclaimer of opinion also. Okay. So these are all the things that you actually learn about ISA 580, last part here. The auditor should issue disclaimer of opinion. I told you, you will issue disclaimer of opinion if the auditor concludes there is sufficient doubt on the integrity of the management. See, if the doubt of integrity of the management is there, that means from the very beginning of the audit, who's preparing the financial statement, management, from there only things will start going wrong. That means whatever you try, you'll never be able to obtain sufficient appropriate audit evidences. So at the end, you will end up giving a disclaimer of opinion. Management does not provide written representation in relation to their responsibility to prepare the financial statement and to provide auditor with information and confirming the completeness of the transaction. So basically, even if this the management is doing, they are not ready to give you in writing that they have prepared the financial statement, they have provided the auditor with information, or they have included all the transactions and all. Here also the doubt will start coming and we say, we don't have sufficient appropriate audit evidences to support our conclusion. So in that case, also the auditor will end up giving disclaimer of opinion. Clear? All right. Now let us go back to the same discussion. Let us take up the revision again. Okay, so that is all regarding the topic of completion and review, where you have to talk about even after you finish the audit. Okay, even after you perform the substantive procedures, even evidences are available with you. You still have to check some more things like subsequent events, check for the going concern assumption to be appropriate, do some overall review by performing analytical procedures at the end of the year. That is, as per ISA 520, we know that analytical procedures should be performed at the end to ensure that whatever evidences you have obtained and what is the understanding of the financial statement, they're on the same page. Then you also do the evaluation of the misstatements identified, check whether all the misstatements have been rectified. If not, check whether if they're uncorrected, are they material on the financial statement. Also obtain written representation from the management. Then regarding written representation, for some matters compulsorily you have to obtain. If you don't obtain, then the auditor will end up giving a disclaimer of opinion. And if suppose written representation is inconsistent with the other audit evidences, you have to reassess your audit planning, risk assessment, and do further audit procedures. And if suppose the management definitely is actually not providing you the written representation that you're requesting, this will cast a doubt on everything. And basically your understanding regarding the assessment of risk will completely undergo a change. This would sometime also end up in the auditor giving a disclaimer of opinion, or he will look into for withdrawal of the audit. or maybe if the laws and regulations do not permit, he will give a disclaimer of opinion. Okay, then we come to the last part of the audit. That means after performing test of controls, test of details, then we did all the completion and review part, that is subsequent event, going concern checking, overall review, analytical procedures, written representations we obtained, everything we have done. So now we have opinion ready with us. Okay, now based on the opinion, you are now going to prepare the audit report, and the entire reporting is studied as per ISA 700 series, and that is the last topic that we have, that is reporting. Clear? Now, in reporting, we are going to study about ISA 700, 701, 705, 706, 720. What is 700? 700 simply talks about how the audit opinion is decided. That means based on the audit evidences obtained, sufficient appropriate audit evidences, the auditor will draft the audit opinion. After the audit opinion is drafted or prepared, then you have to express in writing through a written report. How to prepare the report? The content of the audit report is studied as per ISA 700. Okay, now this ISA 700, what content it is talking about is about unmodified opinion. So when you prepare a report based on true and fair view, then the reporting you do as per ISA 700. Correct? Then you have 701, which talks about something called as key audit matter. Key audit matters are some important items, okay, which the auditor came across during the course of his audit, which he communicated with the management, that is TCWG. But the auditor still believes, even after they communicated the matter with TCWG, they still believe that this particular area was of a real significant importance while performing the audit, where we devoted more of our time, more of our audit resources were, devoted to that particular circumstances, because of which we want to tell the people it was one of the key audit matters that we came across. So we will have to report about these matters as key audit matter in the audit report as per ISA 701. Then you have 705, which talks about modification to an independent auditor's report. So true and fair you prepare as per 700, but suppose if you want to give a modified opinion, okay, then you have to prepare the audit report. The basic content will remain same as that of 700, but this 700 reporting will go under modification, and what modifications are there we study as per ISA 705. Okay, which all paragraphs will change, what is the content that will change, you will understand as per 705. So the very name of this particular standard is modification to an independent auditor's report. Then we have some additional communication which the auditor can do through his audit report, that is 706, which talks about emphasis of matter paragraph and other matter paragraph. And then we have 720, which talks about other information. Okay, so these all are additional informations that you can give through the form of the audit report. Even 701 is the additional communication which the auditor will do through the help of his audit report. Okay, so let us get started with the first one. So first you have the independent auditor's report that you prepared from ISA 700. So ISA 700, the very name says, forming an opinion and reporting on the financial statement. So this standard talks about two things. You first form the opinion and then you prepare report. So it is going to talk about how you prepare how you draft the opinion. So you will look into the, whether financial statements are prepared as per applicable FRF. That means whether appropriate accounting policies are there or not, consistently applied or not, whether they comply with the accounting standards or not, all the estimates are reliable or not. Okay. Then based on that, you'll decide whether, all the provisions, all the estimates, whether they're reasonable or not, consistently application of the accounting policies, whether they're appropriate in the given circumstances, whether all the disclosure requirements have been done correctly or not. So taking into account all of this, you will come to a decision of opinion. Once the opinion is ready, you'll go for preparing the report. Now, how do you prepare the report? For this, the content is given as per ISA 700. Okay. So let us understand the content of the auditor's report. Now, when you talk about content of the auditor's report as per ISA 700, now look at the content. First thing is going to be title. Title talks about the name of the report, that is independent auditor's report. Then you talk about addressee. Addressee is to whom you are writing the report. In the case of companies, it will be addressed to the members of the company. Then comes to the most important part for which we read the auditor's report, that is opinion, where you are going to talk about financial statement giving a true and fair view, or the financial statement present fairly. So whatever language you can use, true and fair or present fairly in all material respects in accordance with applicable FRF. Okay, so that is the way you write the opinion paragraph. Understand 700 talks only about unmodified. So obviously here the financial statement either give a true and fair view or they present in all material aspects or they present fairly in all material aspects. Or if you talk about compliance framework, so they comply in accordance with the applicable financial reporting framework. Then what is the basis for opinion? In basis for opinion, you are going to give why we have given a true and fair view. So we tell that we have done the audit of so and so financial statements. Basically in basis you talk about that we have complied with all the international standards on auditing. We have followed with all the ethical conduct. We have fulfilled all our responsibility, and we have sufficient appropriate audit evidences to support a conclusion. So you are going to write 4 pointers. Okay, based on which you will tell, yeah, we have given this particular opinion. Okay, then after that, you will talk about some additional requirements, like you will be having the going concern section only if ISA 570 will be applicable. That means the auditor is going to give a true and fair view, but he knows about a material uncertainty. So about that, he can give it here. Then we have key audit matters. If suppose the auditor is doing the audit of listed entity, then some additional communication is done in the form of key audit matters. Then you have reporting as per ISA 720, which will not be every time. It is regarding other information. What is other information? I will take you through after some time. After that, you have a very important paragraph regarding management responsibility. In this management responsibility paragraph, they will be writing about they are responsible for the preparation of the financial statement. They are responsible for the designing and implementation of the internal controls. They are responsible for the compliance of laws and regulations. Then they are responsible for looking into for going concern assumption. So all of that is what they are going to talk about their responsibility. After that comes the auditor's responsibility, where auditor will write about his primary responsibility to obtain true and fair view, to obtain reasonable assurance as to the financial statement being free from material misstatement. Then he'll also tell we are not giving a guarantee. It is not a guarantee as to the future viability. Okay, based on the historical data available with us, we have given the opinion. Okay, so basically you're going to write about your audit responsibility. Then you'll be having other legal and regulatory requirements. This depending upon the entity that you're doing the audit. Like for example, in India, we have Companies Act. So when you do the company audit, the Company Act also requires you to provide some additional reporting that you do in other legal and regulatory requirements. Apart from that, there could be paragraphs like EOM. There could be paragraphs like OM paragraphs, which also could be included for providing additional audit evidence information. Then you will be having the name of the firm, signature of the firm, date and place. So these are all the requirements that you have with respect to the audit report that is prepared in the case of unmodified opinion. So you have title, addressee, opinion, basis for opinion, going concern paragraph, CAM paragraph, 720, that is other information, management responsibility, auditor's responsibility, emphasis of matter paragraph, other matter paragraph. See, emphasis of matter can also come here. Okay, it can come even before the management responsibility paragraph. Then you'll have the name of the audit firm, signature of the engagement partner, then you'll have date, place, all of this will become important. Okay, so that is all the content with respect to the auditor's report, and that has been given where in ISA 700, and in ISA 700 very clearly they have told in which paragraph what content has to be written. So the responsibility of the auditor will be to obtain reasonable assurance and then the content of the audit report. Okay, then now comes to the modification to an auditor's report. Now, modification to auditor's report basically talks about 3 opinions, that is going to be qualified opinion, adverse opinion and disclaimer. Okay, so first you need to understand when you give a qualified opinion and when you give a disclaimer of opinion. Now there are 2 possibilities where opinion could not be true and fair. One is where you have obtained sufficient appropriate audit evidences that there are misstatements. Second, you are unable to obtain sufficient appropriate audit evidences. These 2 situations will make a decision of the auditor to be modified. Now, if suppose you have obtained sufficient appropriate audit evidence that a particular item is misstated, then obviously you have to first look into whether it is material. Okay, if it is material, you should see whether it is pervasive or not. Pervasive means it is having an impact on the overall financial statement, or it is having an impact on only one item, but that one item is very material to the overall financial statement, or it is talking about a very important disclosure requirement. So it is something that is going to make the financial statement misleading. We call it to be pervasive impact. So if suppose a particular matter is material but is not pervasive, then you will give qualified opinion. But if the misstatement identified is material and it has a pervasive impact, we will give adverse opinion. Okay, then suppose if the auditor is unable to obtain sufficient appropriate evidence and the possible impact of the same is such that, if the possible impact of the same is such that he is telling that it could be material, but it is not pervasive, then again he will give a qualified opinion. But suppose he believes the possible effect of the same would be material plus pervasive, then he will end up giving a disclaimer of opinion. So these are the ways through which the auditor is going to give opinion on the financial statement. That is going to be qualified. Two possibilities: obtained evidences, material but not pervasive; could not obtain, material but not pervasive, we give a qualified opinion. Second, you obtain evidence but it is material but pervasive. Second, could not obtain the evidence but the possible impact of the same is material but pervasive, you give disclaimer of opinion. Okay, then. Now, types of modification we have already understood. Okay, now what will be the changes in the reporting? Now, when you talk about audit reporting, what you studied in 700 and 705, the basic understanding would be, I'll do it through a proper show into it. 1 second. I'll just share the screen. Understand better. Okay. 700, 705. Title will remain title. Addressee will remain addressee. Now, opinion will change to the type of opinion. So, you will have qualified opinion or adverse opinion or disclaimer of opinion as the paragraph name. Okay. Now, here, what language we write? We have done the audit of so and so. We have done the audit of such and such entities financial statement, which includes balance sheet, P&L for the period ending, along with the corresponding, notes to accounts, summary of significant accounting policies, etc. Okay. So, you will write the language like that. Okay. Here, qualified opinion also, you are going to have the same language written. Adverse opinion also you'll be writing, we could not obtain true and fair view. Okay, we are not giving, so we'll say we are not, the financial statement do not give a true and fair view. In qualified opinion, we'll write, except for the particular matter, the financial statements are going to give a true and fair view. In disclaimer of opinion, the very language only will change, that we were engaged. We will not write we have done the audit or we have audited the financial statement. Yeah, the language will change to we were engaged to do the audit. Okay, then the basis for opinion section, which had 4 things to be written in the normal paragraphs where we used to write about audit was done as per the auditing standards. Okay, we followed the ethical principles, auditor's responsibilities were duly complied with, we obtained sufficient appropriate evidences. Okay, now this will be completely replaced with what? That you will be writing in qualified opinion, reason will come in the basis for qualified opinion, adverse opinion also reason will come. Correct? So very importantly, after reason, you are going to write these particular content. So first paragraph will be the reason and next paragraph in the same qualified reason for qualified opinion or basis for qualified opinion, you will write this paragraph as it is. So first will be the reason. Okay, then remaining all paragraphs regarding management responsibility, auditor's responsibility will remain the same. There will not be much difference there. You need to understand about the key audit matter. 2 important things, key audit matters, okay, and key audit matter and disclaimer of opinion together can never be given. So if you give disclaimer of opinion, key audit matter section will not be there. If key audit matter section you are giving, then it cannot be a disclaimer of opinion. You have to be very clear with it. Okay. Then when you talk about giving a modified opinion, reason for modified opinion should always come in the paragraph of basis for modified opinion. You cannot bring that into CAM. CAM cannot be used to substitute, okay, the reason for modification. So when you write something in CAM, it should be such matter because of which you are not giving a modified opinion. That means this is only additional information. Your opinion is not changing because of it. Okay, so CAM is only additional information. It is not a reason for giving a modified opinion. If there is a particular matter because of which you are giving a modified opinion, that particular matter, however important it is, you will give it where? In the basis for modified opinion paragraph. Understand, basis for modified by very itself is a key audit matter. But you have to include that matter where? In basis for modified opinion. In CAM, you'll include only those matters which, though they are important, they're not going to make the particular opinion a modified opinion. Okay. So that is the basis, some differences that you encounter between 700 and 705. Okay, whereas then you have CAM. I told you CAM are those particular matters where auditor has spent most of his time during the course of audit. So there were high areas of risk of material misstatement, some significant areas of risk or fraudulent factors which they identified, where they thought that this were the places where a lot of auditors' efforts, resources were used, which they communicated with management and TCWG. Out of these matters, as per auditor's professional judgment, auditor believes this has to be communicated to the users also. So we'll include it in CAM paragraph. Understand, CAM is extremely important in the case of listed entities. So listed entities audit report will compulsory have a section called as CAM. If they have some matters to be written in the CAM, then write what is the matter, why you call it to be CAM, how you resolved everything. But if suppose if it is no matter is considered to be key audit matter, even then you will include the paragraph called as CAM, and there you will write that we could not identify any matter which according to us would be considered as a key audit matter. But if suppose you write any matter as key audit matter, then you have to give the description, why you considered it to be a key audit matter, and also how you resolve the particular matter. Because key audit matter, whatever you include, should not be a reason for modification. That is very important. Okay, then. Now, going concern section and reason for modification, both of it by very nature only will become what? Key audit matter. But because we have two different paragraphs separately available in the audit report, though they are key audit matters, we can put them in the separate sections in going concern and reason for modification. Okay, then. I told you disclaimer of opinion and CAM cannot be reported simultaneously. In one audit report, these two sections cannot come together. Now, additional communication happens by 570, which we already discussed, going concern regarding how management has disclosed. If it is appropriate, you give an unmodified opinion, but you will write the material uncertainty in going concern paragraph. If suppose the management has not disclosed appropriately, you will give an adverse opinion, but that time you will bring it where? In the basis, that is reason for modified opinion paragraph. Okay, then 706 talks about emphasis of matter paragraph and other matter paragraph. The difference between two is that if there is particular item available in the financial statement, about this the management has done the reporting perfectly. So you don't intend to give a negative opinion for this particular matter. It has been appropriately disclosed, reported perfectly by the management. But this particular matter is very important, which the auditor wants the people to know about it. Like for example, there is a provision to be created. Management has appropriately created the provision, appropriately given the disclosure. Everything is done appropriately as per FRM. But the auditor believes no, even if it is appropriately disclosed, though I don't intend to give a modified opinion, I want this information to reach to the stakeholders. So this can be emphasized by putting it where? In the emphasis of matter paragraph. So this paragraph will be for those matters which are already available in the financial statement and they are correctly reported. Other matter paragraph is for people to understand how audit was done, or how the audit was carried on, or how the auditor's responsibility was. So this is to understand the auditor's work. Like when we talk about auditor using the branch audits work, or maybe subsidiary company's audit was done by another auditor. Maybe the audit was joint audit. So in that case, when the auditor wants to inform the people about the way in which audit was performed, the way in which the auditor's responsibility was, or how the people should understand the audit report, then that additional matter you can give where? In the other matter paragraph. So regarding financial statement will come in EOM. Regarding auditor's responsibility will come where? In other matter paragraph. Moving on, when you talk about ISA 720, in ISA 720, what you understand? Now, audit report will be included as a part of the annual report. And in the annual report, you'll be having so many information, like you'll be having financial statements are there, there is audit report, there is chairman's message, there is vision, there is mission, there are future projects, future projections, there are talks about the future plans, the director's responsibility will be there. Then new projects coming up. Okay, there are so many matters which are going to be included. Some kind of trend analysis will be done, some future projections will be done, sales analysis will be done. So there are so many n number of information which will be given in the annual return. So as per 720, it becomes very important that the auditor has to give a very clear understanding that the auditor's report is inclined only or is reflecting only the financial statements. Okay, and it does not ensure any kind of responsibility or the other information which is available on the annual report. But suppose if there is some information which the auditor already knows that no, this particular matter is misstated in the annual report and it is something else given in the financial statement, then if that information the auditor wants to bring to the light of the stakeholders, he can use the additional communication through ISA 720. That is regarding reporting other information. Okay. Then communication with TCWG, that is ISA 260 and 265. 265 we already touched upon, where we spoke about in the topic of internal control, where we know that the auditor, when he identifies deficiencies in the internal control, he has to pick up the significant deficiencies about which he has to communicate to the management and TCWG. So that we have understood very clearly. ISA 260 talks about some other information which is mandatory to be communicated to the TCWG, like if there are some kind of misstatements analyzed during the course of audit which management does not resolve, or maybe regarding the going concern matters, you have to communicate with the management, TCWG. Then when you talk about the proposed wordings of the auditor's report, when you intend to give a modified opinion, so there are certain matters compulsorily you have to communicate with whom? The TCWG. So basically this particular standard, when you go through the study material, okay, you'll be able to understand there are certain very important matters that you communicate with TCWG, and that is given by 260 and 265. 265 you already took as a part of internal control. This will quickly have a glance, okay, through the study material. Okay. Okay, this chart is sufficient enough for you to understand what we're talking about. Now, communicating with TCWG, this is going to be ISA 260. Okay. How? Obviously, engagement letter we communicate. Management letters also we discuss. Okay, like management letters we give a deficiency of the internal control. Correct? That we give through the form of management letter. Then dialogue is the oral communications that we have with the TCWG. What we communicate about the accounting policies, any risk, any adjustments which the auditor wants to make, any disagreements with what they have reported about what you consider, any modifications that you want to make to the financial statements that you have, to your audit report that you discuss, any kind of deficiency that you see in the internal control, that also you discuss with the TCWG. When can you do the discussion? Either during the planning stage, so engagement letter, all of this we do at the time of planning stage, even accounting policies we discuss, risk we discuss during the planning stage. During performance, we come across during disagreements, management letters and all that. After the audit is completed, then whatever deficiency you identified, whatever modifications we are going to do, okay, that we have to talk to the TCWG, tell them about the proposed wordings, what kind of modification is there, okay, what kind of reporting we are going to do. All of this we are going to communicate with TCWG. So basically, this particular standard is going to talk about what reporting will be required by the auditor to be done with TCWG. Okay, so two parts we discuss about TCWG and management. One is 265 about deficiency in the internal control, and one about the matters that we discussed with TCWG mandatorily. See what we plan, what is the proposed planning, which areas, everything, the scope and everything. We definitely discuss with whom? The management, that we do in the form of engagement letter also. Management as in TCWG that I'm referring to. All right. Okay. So let us go back. So this was the topic regarding reporting. Okay. When you look into the main syllabus, okay, where we have done this topic in detail, there we have done this particular part of reporting exhaustively, very comprehensively we have covered, and we have understood each and every reporting element in detail. So that is one particular chapter where in-depth understanding has been done, where you'll understand when what modification should happen, when reporting will change, what should be the basic content, how the content will undergo a change, when you have CAM, when you have going concern included, when you have EOM, when you have OM paragraph, when you have the other information to be reported, everything has been done in detail. Okay, so today I've tried to give you an understanding of the summarized way of all these particular, standards. But when you look into the main course, you'll be able to understand how detailed you can actually go through all of this. Okay. Okay. Now let us take one question from the examination kit. That is from page 89. We have question 156. Okay. Let's do the discussion of this. Yes. So we are on page 89, question number 156. Okay. So there is a scenario given to us, and all the upcoming questions from 156 to 160 are going to be based on this. Okay. So reading has to be proper here. It is 1st of July 2015. The following scenario relates to the question 156 to 160. It is 1st of July 2015. You are an audit manager of Blanklane and Company, responsible for the audit of Samsung Company, a large listed retailer. The audit for the year ended 31st March 2015 is nearing completion, and the auditor's report is due to be signed next week. So we are now in the last leg of the audit. So basically, it is obviously talking about completion and review. Okay, then you have been informed that the financial controller left Samsung Company on 28th February. As a part of the subsequent events, okay, audit procedures, you reviewed post year-end board minute meetings and discovered that a legal case for the unfair dismissal has been brought against Samsung Company by the financial controller. So here, if you can see, there was one of the employee who was eliminated, removed, and this happened when? On 28th February, that is before the year ending. And after the year ending, when you reviewed the post year end board meeting, you saw that there is a legal case which this person has filed against the company for unfair dismissal. Okay. During a discussion with the human resource director of Samsung company, you established that the company received a notice of the proposed legal claim on 10th of April. So this came immediately after the year end. Okay, 31st March is the year ending. Okay, it came after the year end. The HR director told that the Samsung company's lawyer believed the financial controller's claim is likely to be successful, but the estimate that $150,000 is the maximum amount of compensation which would be paid. However, the directors do not intend to make any adjustment for the provision or to include any disclosure in the financial statement relating to the issue. Okay. The draft financial statement currently show a profit before tax of $6.5 million and a revenue of $66 million for the financial year ended 31st March 2015. So you need to understand here they're talking about subsequent event. They talk about a person who has left the organization on 28th February, that is before the year end. And he has filed a case after the year end, that is for the condition that already existed before the year end. He filed a case for which the notice was received on 10th of April. The lawyers has given a confirmation that there's a possibility there could be an outflow and the estimate will be $150,000. Looking at this particular amount, that doesn't seem to be material. Okay, let's see the questions. So first of all, from completion and review and reporting, you can have questions in both. Objective also and descriptive also. So section A, section B, both could be questioned on. Now, subsequent event procedure should be performed between the date of financial statement date or which date. For this, you don't have to read the case study absolutely. As I told in the very beginning when I used to give the introductory classes for this particular subject, I told you many a time it so happens that you really don't have to read the entire case scenario to answer few of the question. So this is nothing to do with the case scenario. The question is based on the concept of subsequent event. So what is subsequent event? Event after the balance sheet date, up to the date of the auditor's report. So which is this? Subsequent event between the date of financial statement and which date? The date of the auditor's report. So you don't do elimination also directly, you can pick up this particular period is considered to be subsequent event. Which of the following audit procedures should be performed to form a conclusion as to whether the financial statement require amendment in relation to the unfair dismissal? Okay, which of the following audit procedure should be performed to form a conclusion? So whether you require to do an adjustment or not in the financial statement, how will the auditor give a conclusion for that? First of all, you will inspect relevant correspondence with Samsung company's law. Yes. To understand whether probability is there of outflow or not. Okay, first of all, you have to have the conversation with lawyers. So this you have to do. Write to the financial controller to confirm the claim and level of damages. Review the post year-end cash book and the bank statement for evidence the claim has been settled. Okay, check whether they have done any payment to settle the claim. Okay, that means that also would require adjustment, obviously. Request management confirms their views on through a written representation. Now here, obviously, 1, 3, and 4 you will do only because it is some of the responsibility of the management. Subsequent event, you obviously end up taking a written representation. You will check this to ensure whether provision to be created or not to be created. And lawyer will give you the estimation of the amount. Okay, and the probability of whether outflow is going to be or not. But why will you talk to a financial controller? And that too about to confirm the claim and the level of damages. So confirmation with him is not going to give an indication of what kind of adjustment you require. Okay, so that will not be there. So the answer here should be 1, 2, and 4. Sorry, 1, 3, and 4. So you have to check 1, 3, 4. So it should be C. Okay. You can see the questions will not be that complicated. You can actually attempt it well. Okay. Select the type of opinion that is appropriate and the nature of any additional communication necessary. Select the type of opinion that is appropriate and the nature of any additional communications necessary if the unfair dismissal case is not adjusted for or disclosed within the financial statement. See, first of all, you need to understand for any kind of modification if you give, okay, the item has to be material. If you look at the particular matter of $150,000, when you compare to the 66 million and the PBT that is given, okay, that particular amount does not seem to be material. So the very understanding of whether we check for pervasiveness, no pervasiveness and all of that, that will not become relevant because the amount itself is not material. So when the amount is not material and if the disclosure of the same or adjustment of the same is not done, it is not going to be a material misstatement for us for which we are going to evaluate. So you can definitely go on giving an unmodified opinion. And obviously, no further communication will be required. See, emphasis of matter you will be giving only when you are going to have some material information to be communicated about financial statement. And if it is correctly disclosed, nothing is correctly disclosed here. So EOM won't come. It has nothing to do with entities going concern. The amount is not very big when compared to the company. And other matter not required because there is nothing to talk about auditor's responsibility. So no additional communication required. Either you can write directly or you can do elimination criteria. You can see it will not fit in anywhere here. So no additional communication. And obviously, because it is not material, it is unmodified opinion. Okay, then we will go through the answer also so that you'll be sure about what we are doing. You are drafting the auditor's report for Samsung company, and the audit engagement partner has reminded you that Samsung company is listed entity. We saw that it's a listed retailer. So obviously, it's a listed entity. The report will need to include a key audit matter section, obviously. According to ISA 701, communicating CAM in the auditor's report, which of the following should be included in the CAM section of the auditor's report? So what defines CAM? For this also, you don't have to read the scenario. This is basically concept of CAM. Matters which require significant auditor, obviously, the first one. The matters which require significant auditor's attention is only CAM. Matter which result in modification, no, that you'll always include in which paragraph? Basis for modified opinion. Though it is by nature CAM, key audit matter, but you have a separate section in the audit report, so you'll include in basis for modified opinion. All the matters which are communicated to TCWG, no. Though CAM is out of those matters which are communicated to TCWG, if you communicated 25 matters, all 25 will not come as CAM. So no. All matters which are material to the financial statement, no. So the answer will be those which took a lot of time of the auditor or which were for auditor significant. Auditor's attention, it was very significant. Okay, let us take the last question. 1 month after the financial statements were issued, the legal claim was finalized with the court awarding compensation of $500,000 to the ex-financial controller. The director of the Samsung company have contacted Blenkling and company to inform them of the outcome. 1 month after the financial statements were issued so financial statements are issued. So it is a fact known to the auditor. After the audit report has already been issued. Okay, so in this case, what you will do? Very simple. You will first discuss with the management and see what are the requirements to do, how they can address this particular matter. So first discuss the matter with the management and where appropriate TCWG, this is correct. So 2 things you have to find out. Obtain a written representation. No, not required. Consider whether firm should resign from you've already given the audit report, so no point of resigning. Inquire how management intends to address the matter in the financial statements where appropriate. The answer will be 1 and 4. Written representation, why? No longer audit evidence required. Audit report is already given. Audit evidence you will obtain only to the point audit report is not signed. After that, we don't require written representation. Written representation you will obtain only and only before the audit report is given, not after that. Correct? So written representation not required, resignation criteria not there because audit report is given. So 2 things are discussed with the management and understand what would be the appropriate action. Okay, so these are the understandings that we have with respect to the answers coming up here. We will quickly go through also the answer so that you get an understanding of how you evaluate the answer in the exam. Okay, so the first one we took was option 1. So it was talking about what you mean by subsequent events. So we spoke about event occurring after the balance sheet date to the date of auditor's report. So here there was option 3, which we did not do anything. We don't read all the 4 options. We directly picked up and wrote it. So if the management assesses a period of less than 12 months from the date of financial statement, auditor must request them to extend to the assessment on this side. The status is fine. Then comes to going concern. The client has made adequate disclosure uncertainty related to going concern. Therefore, the opinion is unmodified. As per ISA 570 going concern, where there is a matter of fundamental importance to the user's understanding regarding an uncertainty relating to going concern, the auditor should include material. 1 second. I think we missed out one question, 155. Yeah, this part we have not taken, 154th. Which of the following is an appropriate course of action for the auditor to take in respect of management's going concern assessment? Request the management to extend the assessment to the date of auditor's report. Design and carry out the procedure to only assess going concern in the period from 31st March to the date of auditor's report. Request the management to extend the assessment to cover at least until 31st March 2016. So 156 was from where we started. So we understood the meaning of subsequent event, and subsequent event, it talks about date of financial statement to the date of auditor's report. And that's the reason the earlier question did not make much sense. Okay. The explanation regarding going concern, right? So option 3 is correct. 157 talks about, the one which I told you that you don't have to contact the financial controller. So all the 3 procedures were correct, but you don't have to contact the financial controller because he's no longer the officer of the company and is a party involved in the claim. So how can he confirm about the level of damages and all that? Then 158, I told you it was not material because it is just 0.2% of the revenue or 2.3% of the profit, which we can ignore. So that is immaterial. So it can give unmodified opinion. And I told you with elimination criteria also, no additional communication will be required. Then what is key audit matter? By the very definition, it requires significant auditor's attention. So it was the first option that we had picked up correctly. And then finally, we understood that 5 lakh represents 7.7% of the profit before tax or 0.8% of revenue. Therefore, obviously, it is material because that was $500,000. Had this outcome been known to the auditor before the financial statements were issued, they would have required adjustment. and because of which the auditor should initially discuss the matter with whom? Management, and understand how the management will address the matter in the financial statements. Because look at the amount now, it is $500,000, which is going to be really material. So in that case, the obviously auditor cannot be reluctant. He has to check with the discussion with the management. He has to then have a conversation with them and understand how they're going to issue the matter. Okay. So what we read earlier, just to make it very clear to you, what we read earlier was actually not appropriate, because all of this, what we spoke, the 12 months period and all, even I was having a double cross of what we're actually discussing, because 12 months period is something that we didn't discuss anywhere. Okay, so going concern question we have not taken. Okay, definitely we'll take up the questions when we do the last set of revision, where we are going to get exposed to more questions. Today's questions began from 156. Okay, so that's one correction that we have to do. All right. Okay, so 156 to 160 is what we have done, and all of them have rightly been approached by us. So I believe the kind of question in the examination you'll be able to deal with. Okay. Okay. So we have actually completed this entire part of discussion regarding completion and review, where you have understood properly regarding how you complete the audit even after performing all the audit procedures. Okay, even after substantive procedures, we still cannot say the audit is completed unless we do all these subsequent event, going concern, overall review, analytical procedures, obtaining all the written presentations were required. All of these things, or evaluation of the misstatements, uncorrected misstatements, all of these you still have to do it. And only then you can say that, yes, we have enough conclusions to draw our opinion. Once the opinion is ready, you prepare the audit report, and audit report is prepared as per all the relevant standards, that is 700 series, and all the 700 series have some additional input to be understood, where some talk about unmodified opinion, some talk about modified opinion, some talk about additional information. Also, we took up one question for our understanding, where we saw about how we need to analyze the situation, how to understand the questions will be. Also, one very important understanding that you should have is, not every question in the descriptive part will be requiring the reading of the question completely. Some will be directly based on concept, where scenario will not make that much relevance to you. So don't spend much of your time in understanding and interpreting the scenario. Have one reading of the scenario, go through quickly to the questions, and then see if the question is talking something specific about the scenario, then you can go in the reverse order. But initially, only don't spend more of your time in reading the scenario. That will not help you. You start reading the questions also, and based on that, you'll understand where you have to focus in the question. All right. So with this, we have finished the 4th session of our revision, and we'll continue in the next session with the last part, which talks about all the fundamental aspects. That is the basic framework. Okay, with respect to code of ethics, fundamental principles, all of that. All right.